You're listening to Seattle Real Estate Podcast.
Thousands could soon lose or sell their homes as COVID mortgage bailouts expire. So at the onset of COVID, we just literally shut everything down. It was chaos. Your company's essential. Oh, no, yours isn't. Even though they're about the same, this business is going to stay open. Big box businesses open, small businesses, not so much. You're essential. You're not. We had all that going on, right? And what lenders did is they did a mortgage forbearance, meaning they came up with programs that allowed people to stay in their homes, even if they weren't able to make payments due to getting laid off or their business shut down. Any one of those number of issues that probably shouldn't have happened anyway, but they did. We're now at that point where we're talking 18 months later when people have taken advantage of these forbearance programs, that we're talking, the moment of reckoning is coming. So I'm going to walk you through this article. This is a CNBC article. So it always kind of leads with, thousands could lose their homes. I don't think it's going to be that bad. I don't think it's going to be bad at all. Lenders have learned from the Great Recession that when they take a house back, they're going to lose even more money than if they can figure out a way to keep the homeowner, the mortgage payer, going. So they're going to enable people to stay in their homes as best they can because they're in the business of making money, and foreclosing on a home, lenders do not make money. They learned that one the hard way by taking back hundreds of thousands of homes during the Great Recession. And our bottom line still not good. We're not making money here. In fact, we're bleeding out millions and millions of dollars. Too big to fail. Till they weren't. All right. So thousands could lose or they could sell. And that's kind of the big kicker in this article is, what are you talking about? They could either lose their home or sell it? That doesn't make a lot of sense. That's what we're going to dive into because that's really the crux of this one. Before we do, if you're new here, welcome. My name is Sean Reynolds. I own a couple of real estate companies. I own a real estate brokerage. We sell real estate, and an appraisal company. We appraise real estate. So I read the news from that perspective. Let's get going. Enough of the chit chat. Hundreds of thousands of homeowners could soon lose or sell their homes as COVID-related mortgage bailout programs expire. The federal government, big banks, and mortgage servicers started emergency programs when the pandemic hit early last year, shutting down vast swaths of the economy. The bailouts allowed millions of homeowners to miss payments for up to 18 months. We're in the midst of the largest transition out of forbearance we're likely to see ever, with 750,000 homeowners leaving plans over the past 60 days. So 750,000 people. That's pretty small considering the number of, population of the United States, 330 million, somewhere in that range. It's only 750,000 have been leaving plans over the past 60 days. That's a lot of people, but in the big scheme of things, those numbers are not that crazy. And so what a lot of this tells me is people have figured it out. They have worked it out. If they've gotten a mortgage since the Great Recession, maybe they went through that process back then when they did either a foreclosure or they did a short sale. Those are not good things to have on your credit. People have kind of worked out, all right, if there's help available, I'm going to take it. The programs were largely successful, the forbearance process. Over half of the 7.7 million borrowers who piled into bailout programs are current on their mortgages and making payments again, according to weekly data from Black Knight, a mortgage software data and analytics company. About 23% of the borrowers either sold their homes, refinanced their mortgages to make them more affordable. Now, that's been a big thing, is refinancing, because then you can lower your payments. But if you are out of a job, or if your business got shut down and you had some major cash flow issues, maybe you're trying to work your way out of that. But in those cases, refinancing doesn't matter because if you don't have the money, you don't have the money. That's the bottom line, right? But I think the numbers of Americans who don't have the money or don't have the income, they are way, way less, obviously, than the Great Recession, when we saw just enormous numbers of homes being foreclosed. And lenders hadn't been through really that process for, long time. I don't know when the previous recession would have been where we would have seen those kind of numbers. I'll get back to you on that though. So roughly 7%, or just over 500,000 homeowners, are in active loss mitigation with their lenders, still trying to work out a loan modification plan. All right. Some of those folks would probably be there anyway, just due to various life circumstances. You've always got that. But I think the vast majority of people are back up and running. We don't have, you remember all the hysteria? Would have been like March of 2020, just mass hysteria when we closed down the economy. Mass hysteria, especially as it came to housing. I'll have to look back in some of those topics, because that's when I started to daily podcast. And man, the news stories I was reading then, I was like, there's no way this is going to happen. Is it? I mean, we just didn't know what was going to go on, right? We knee-jerked the pandemic so hard. Just crazy. Hundreds of thousands of homeowners remain in a tough spot, however. 3% of borrowers, or approximately 264,000 homeowners, are now delinquent on mortgages after their programs expired, meaning their lenders gave them some extra help, maybe allowed them to miss some payments, maybe lump some those payments onto the tail end. Don't have to come up with the money right now. That's what lenders are kind of doing. In some cases, I've had a lot of people tell me, man, I should have never taken the mortgage forbearance process. I should have just worked it out on my own, begged, borrowed, from family and friends, whatever, to make it happen. Because it's been a real grind for a lot of folks they're trying to work through the forbearance process, get something affordable that they can work out payments wise, because they want to keep the house. Housing equity has risen so much in so many different markets that people want to keep their house. And 38,000 homeowners are in active foreclosure. All right. That's a lot of folks, but that's across the United States. So take that into consideration. What I'm seeing right now is people nervous. A lot of them are coming off forbearances, some of them still not working and not knowing what to do. I try to instruct them first to contact the servicer or the lender and find out what their options are. If you're not actively reaching out to your mortgage servicer, you need to. You need to figure out what the game plan is. That's what we're talking about here. But I think most people who entered into a forbearance program back in, spring of 2020, they're going to be in contact. If they proactively reached out, they're going to be in contact with their lender. So unless you've just been literally living under a rock and still paying your mortgage or not paying your mortgage, reach out to your lender. That's the number one thing to do. Be in communication, because otherwise the lender is just going to be forced to go ahead and foreclose on you. And you don't want that. You have a foreclosure on your record. That's a tough one for years down the road to get away from a credit standpoint and from buying a home standpoint. There are not a lot of options for borrowers who lost too much income or their businesses during the pandemic. Servicers have been offering loan modifications and lower interest rates, but some borrowers simply can't pay. Servicers also advanced money to borrowers for taxes and insurance during their forbearance period. And while that can be spread over a number of years of payments or tacked onto the end, some borrowers can't afford that increase. There are services out there that are willing to help, Diaz said. But again, it's not their fault that COVID happened. So they're relying more on the borrower to fend for themselves. A possible way out. So there is another option. There are other options, right? Selling. Or if you can somehow manage to get some kind of home equity line of credit, something along those lines, maybe you get a hard money loan with some kind of deferral, but you need to reach out. You need to explore your options. I am not the guy that's going to tell you, okay, you should do this, this, and this. What I know is that you need to reach out to your lender, exhaust all those options, and then go from there. And mortgage expert, mortgage broker, somebody at your credit union, start with them as well if you haven't gone down those roads. But the other option is selling, because never during a pandemic or something along those lines that impacts the economy overall like that have we had such a run up in equity through home ownership. Just, it's insane that the market has gone this direction, but it has. So know that maybe selling your home is an option, even if that means getting out from underneath all this, taking a breather, you don't have a job, whatever it is, something along those lines. You'll be able to hit the reset button, even if you don't have much equity left over after all the selling costs and all of that. But you won't have a foreclosure on your record, and you also won't have a short sale on your record. Two pretty big dings to your credit. If you can sell, that is an option. And that's the huge difference. And that's why in the title of this article, they said, or sell, because back in 2008 through 2014, whatever it was, most people didn't have enough equity to be able to sell and get out without doing a short sale. And that will impact your credit. So there's another option, selling. Thanks to a massive run on housing during the pandemic, home prices are up nearly 20% from a year ago, according to various measures. That is insane. Here in Seattle, some of our markets, more like 30%. That is unhealthy, not sustainable, unhealthy. It is what it is, but I'm not cheerleading that as if, oh, that's a great thing. Never before have we seen houses rise that fast. Because if you're in it for the long haul, if this is one of your businesses or maybe a couple, if you're a homeowner, yes, you've probably increased your equity by a lot. But for the overall market, that kind of run is not sustainable and it's not healthy. And you are literally pricing out people from the marketplace that should be in there in order to keep, that move up buyer moving up and keeping the real estate market healthy. We've taken out that entry level home buyer entirely by this run in so many markets, specifically the expensive West Coast ones, right? So as a result, about 87% of homeowners currently in foreclosure have positive equity, according to analysis by RealtyTrack, a foreclosure listing site based on data from its parent company. These borrowers owe less on their mortgages than their homes are worth. For those 264,000 people now delinquent but not yet in foreclosure, they likely have significant equity as well. That is the massive difference between what we're experiencing right now versus the Great Recession, 2008 through whenever, 2005, depending on where you are in the country, 2006. The equity dropped, prices dropped. We had all that product on the market, all of that inventory. And as people tried to sell their homes, if they couldn't sell it, they'd drop their price. Their neighbors would drop their price. Their neighbors would drop their price. As all these prices dropped, you've got a decreasing market. In today's market in 2021, we are still increasing. We don't have enough supply. Interest rates are still super low. We've got massive demand in some of these markets. I was down in Oklahoma City. I know I talk about that a lot, but that's my most recent trip to go see my parents. And I looked at some of the housing down there. And they just don't have the massive numbers of people coming in employment-wise. So they have more of a stable market. Maybe a few percent appreciation, something like that. I don't actually know what the appreciation was in Oklahoma City, but it's probably greater than a few percent. But should have looked at that beforehand. But pricing, bottom line, is not going through the roof like it is in, a San Francisco or Seattle or so many of these other markets. It's not just like, oh my gosh, because we are literally seeing probably right now in some markets, $100,000 price jumps in a month. And these are not for spectacular homes. They are for what you would consider slightly above starter home. You would consider, a 3-bedroom, 2-bath type home. Just, above a 2-bedroom, 1-bath, but not significant, not huge, but what people can afford and comfortably, maybe have a couple of kids, the dog, the fence yard, that kind of thing. We're seeing some jumps of $100,000, $200,000 a month right now. And that is insane and not sustainable. Bottom line. So this is a wildly different market from what the market looked like during the last housing market boom and bust, when about 1/3 of all homeowners were underwater on their loans. And what do we mean by underwater? We mean that their mortgages were, say their mortgages were 300 grand and their homes were worth 200 or 250. That's upside down. That's underwater, meaning you have no equity, you have negative equity. Mr., Mrs. Bank, here's the keys. You take this bad boy back because I'm not sticking around to deal with something with that much negative equity. And that's why we had such a huge foreclosure issue and short sale issue. Years and years we dealt with foreclosures and short sales. Do not want to go back to that. But it's part of the market. Markets go up, markets go down. But I don't think we're going to see that down market anytime soon, because huge difference is people have got a bunch of equity and there's no inventory on the market. And that's going to continue into 2022, guaranteed. For how long? I don't know. How long are interest rates going to stay low? First half of 2022, probably. Inventory going to be tight? Yep. Got the same dynamics, right? So this could be a boon to an incredibly lean housing market, which has seen record low inventory for more than a year. Builders have not been able to ramp up production significantly due to labor and supply chain issues. Some estimates are that the market needs to be at 500,000 more homes to satisfy demand. We need millions and millions of homes more. While these homes wouldn't fit that entirely, they'd make a dent. Well, only a fraction of the homes that we're talking about are probably ever going to hit the market. So you're not going to see massive inventory. That is hopeful thinking. And that is basically logic that authors of real estate articles put together because they bring in eyeballs. Bottom line, right? Because when I read through this stuff, I'm like, okay, all right, there's the angle. All right, that's a tiny little fraction of the marketplace. It's not really going to impact supply much at all. Roughly 73% of borrowers in foreclosure have more than 20% equity, and about 28% have more than 50% equity. Those are insane numbers. You're talking about people in foreclosure that have more than 20% equity. Sell that bad boy. When they get to the end in that process, don't let it go to foreclosure. Sell it. Because if you've got 20% equity, you've got enough money to get out. And about 28% have more than 50% equity. They're not going to let those homes go back. They got way too much money invested. They have the right to that equity. Those homes aren't going back. So the fact that they're going to sell, odds are they're probably not. And if they do, they're not going to have a foreclosure and they're going to sell on the open market. It's going to be a little bit of inventory, but not enough to make a dent in anything. Well, having equity didn't prevent them from defaulting on their loans. It should provide them the opportunity for more of a soft landing, the ability to sell their home at a profit, satisfy their debt to the lender, and have money left over to give them a chance for a fresh start. That's the enormous difference between right now and the Great Recession. That has not been the case so far. Black Knight found that nearly 1/3 of homeowners who got started during the foreclosure process with at least 40% equity in their homes go to foreclosure anyway. And I don't get that. I do not understand that, other than people not understanding their options. So always, if you're facing a foreclosure, reach out to somebody that knows something about real estate. If you have friends in this category, have them reach out to somebody, because there is probably a very good chance that they can work their way out of this one. Even though maybe they've missed payments for the last 2 years, who knows? We had people doing that, for years and years during the Great Recession. I did have a number of people, I don't know if you remember the guy in New York who hasn't made a payment for like 21 years on his mortgage. He got a loan through Washington Mutual, friends of the family. They were out of Seattle here, too big to fail, and they did. But he made like one payment, and he's been in his house for like 20 something years. He finally got the boot. That guy was a jerk. He just worked the system. The number of post-forbearance loans in active foreclosure has held essentially flat over the last 90 days as servicers continue to forego foreclosure actions in favor of other loss mitigation options. Lenders don't make money when they foreclose on a property. They have to spend resources, and they're not in the business of taking a property back because they're going to lose money and they don't like to do it. So they're going to try and keep you in that home somehow because it's in their financial interest. They're not helping you out because, big lenders they're not your buddy. They're not your friend. They're in the business of making money. And if they can keep you in the home somehow, that's what they're going to do. And you should want to do that because then your credit doesn't get ruined. We shouldn't be lulled into a false sense of security, however, as a significant pocket of foreclosure risk will continue to persist throughout much of the first half of 2022. Yeah, but is it really? Really? No, I don't think so. I liken this scenario of the forbearance going to foreclosure. I liken this scenario to the great 11 million people are going to get foreclosed upon or going to get evicted because they haven't paid their rent. Have you seen that as a storyline lately? Have you seen thousands of people hitting the streets due to eviction, due to non-payment of rent? Yeah. How many times have I covered that recently? How many? Going to go with, you got it, the big goose egg, because that's not a storyline right now. There are a normal level of people. Maybe it's slightly elevated being evicted because we're still working through that whole eviction process. But I think the vast majority of tenants who are behind on rent that wanted to take advantage of the federal funds being distributed to the state and local governments, then given out to landlords to bring back, rent to current. I think the vast majority of that money went through kind of the fast track over the last few months. And if you want to be part of that process, you can be part of that process. And so as a result, we're not seeing the huge headlines, right? Like we saw there for months and months and months. That's not happening. It's not a thing. So I liken these headlines here we're seeing with CNBC to that, where if it bleeds, it leads. Great. Is it reality? No. Not the reality that I'm seeing, not the reality that I'm experiencing. Maybe you're experiencing something different. Let me know in the comments. Let me know. Because the numbers I am seeing tells a different story. So let's finish out this article. They may have equity, but there's a matter of where they're going. If you get out, if you're behind on your payments and you have the chance of selling your home, getting a little bit of cash or breaking even versus foreclosure or short sale, take that opportunity because you can, no matter how bad you're feeling about what you've got going on, maybe you lost your job, maybe you had something wild go on with your lifestyle that set you back. If you don't have a short sale or foreclosure on your record, you can do it again down the road. And I know you might not be in a position where you can mentally work your way through that, but give yourself that option. Bring a real estate agent in if you have to. I'm not sounding very positive on that, am I? But what I'm saying is that if you're in that position where you're like, oh my gosh, what am I going to do? Bring in a real estate agent and see what you might be able to get for your home. Have them run the numbers. See what you got going on. You might be able to get out of it. I'm just saying, take that opportunity because this is one of the few times during something like a global pandemic where we've had values rise to the point where people, if they're behind on their payments, they can probably get out of their mortgages whole, meaning they're not going to have to do a short sale or foreclosure. So where are they going to go? Well, let me reread this again. They may have equity, but there's a matter of where they're going. Figure that out once you've got your home past foreclosure, short sale, right? Figure that out. Get that squared away because then you can always operate later on. Where are they going to go? Where are they going to purchase? Maybe you rent. Maybe you move in with relatives. Maybe you hunker down and figure it out. That's what you're going to do. Take one step at a time. Things are so expensive. The market is high right now to purchase and to rent too. That's a big problem. Yes, it is, but it's a problem everybody's kind of working through. Maybe you make a downsize move to a community that's less expensive. Maybe you get a job that doesn't pay you as much, but your expenses aren't as high. Maybe you do something along those lines. There's lots of options out there. That's the bottom line. Explore those options. Reach out to some kind of real estate professional, somebody in mortgage that can maybe help you refinance. But if you've lost your job, don't have the income to support a new loan, take a look at selling and see what that looks like. And I'm not saying that because I own a real estate company. I mean, I am, but I'm not trying to generate business here. Hey, we don't have any supply. Come on down, bring your listing to us. We'll get it sold. That's not my point. My point is that if you are experiencing financial difficulty and you're in the process of having your home foreclosed upon, there may be options that can help you out. And so that's why I say, work it out with your lender first. If you can't figure that out, maybe look at selling as an option. And then if you can't, next step would be to look at a short sale, work out some kind of deal with your lender where they're going to be willing to, basically take the majority of the hit on your upside down equity when you sell. Last option is the no option. It's where you just basically do nothing and let the house go back to the bank in a foreclosure. And I don't want to see that happen for anybody. That's a very hard process. It's demoralizing and nobody wants to experience that. But it does happen and you can regroup from that given enough time. So that's not the end of the world either. But if you have options, take one of those options and run with it, because it's going to be better than having the after effect of having the impact to your credit down the road. All right, that is it for me. And any of this stuff, reach out to your bank, reach out to your mortgage professional. I have a background as an appraiser and a real estate broker, so don't take exactly what I say literally to the bank. You can take it to the bank and discuss it with them, but get your information from those sources. Because you've got, if you're, in trouble, you need to figure out a way out. And there's plenty of professionals out there that can probably work you through. But that first step is you got to make that reach out. You got to make those phone calls and get that process going. And that's the hardest process when you are, you've got a foreclosure going and you're like, all this paperwork coming in and like, what am I going to do here? Got to do something. Make that phone call to somebody. Get a referral from somebody that can kind of start you down the process of, hey, what are your options? And work that way. And that first call, make that to your lender. Okay, that's it for me on this one. Thank you so much for being part of the Seattle Real Estate Podcast. Hey, look, we actually did a real estate podcast. Interesting. Thanks again for being here. I'll catch up soon. Till then, stay safe. We'll talk again. Bye for now.